Hi, my name's Eric. I'll be reading you selections from Barron's magazine. Issue date is May 11th of 2026. It's produced by the Audible Local Ledger. This is a reading service exclusively for people who are blind or print disabled. We start with Up and Down Wall Street. Coca-Cola keeps beating PepsiCo. Buffett's still a fan, by Andy Serwer. One of the more surprising stock stories of 2026 has to be Coca-Cola's year-to-date outpacing of the S&P 500 index and its ancient foe PepsiCo, with the latter point being as significant as the former to well-versed investors. Of course, this is the shortest of short time periods, the very opposite of what Coke's biggest champion, Warren Buffett, the recently retired CEO of Berkshire Hathaway, would consider prudent. In fact, over the past 9 years, basically the tenure of Coke's former CEO James Quincy, who stepped down on March 31st, Coke's stock performance has been decidedly meh versus the market, though again, superior to Pepsi's for those keeping score at home. Why then does Berkshire continue to hold 400 million shares of Coke, a stake that Buffett built in the late 1980s and is now worth some $31 billion, accounting for 9.3% of that company and 9.6% of Berkshire's investment portfolio? Parenthetically, note that new Berkshire CEO Greg Abel has called Coke one of Berkshire's core 4 investments, along with Apple, Moody's, and American Express. A look at the current state of Coke, by America's side for 140 years of its 250 years, provides some compelling clues. First, let's acknowledge the brisk headwinds that Coke faces. Those include GLP-1 drugs like Ozempic and Mounjaro, which might lessen consumers' cravings for sweet drinks. Inflation, which shrinks margins. Taxes on sugary drinks in some countries and jurisdictions, which could reduce demand. Wars around the world, and an unproven CEO in Enrique Barron. Feel the breeze? Those negatives, though, make Coke's recent little pop that much more eye-catching, with the company reporting adjusted earnings of 86 cents per share in the first quarter, above the consensus of 81 cents per share. Coke Zero Sugar continues to be the star attraction, with sales climbing 13%. Pretty darn impressive, Goldman Sachs analyst Bonnie Herzog tells Barron's. And it's not just this year, I'd say also last year. They continue to deliver above their peers. B of A Securities analyst Peter Galbo rates Coke as a top pick. It's probably the only company across the 40-odd that we cover that will hit its growth algorithm this year. Top line, operating profit, growth rate, and earnings per share growth, he tells Barron's. How is Coke managing that? Galbo notes that Coke has outsized exposure in markets like Latin America, Asia Pacific, and India, which has served Coke well, as domestic growth's been sluggish. And he points out that Coke is a pure-play, all-weather beverage company, meaning it has soda, Coke and Sprite, water with Dasani, protein drinks with Fairlife, teas like Gold Peak, coffee with Costa, juice, that's Minute Maid, and sports drinks with Powerade. Beverages relative to food, where we're all counting calories, is a much more resilient category, Galbo says. You drink beverages because of hydration, for caffeine, or post-workout or pre-workout. The real key, though, is Coke's business model. The company is an asset-light, global money-making machine, expert in selling concentrates and syrup mixtures to its bottling partners, marketing, and optimizing its products and pricing. Coke is hardly infallible. Anyone remember New Coke? But it hits more often than it misses, and arguably Coke is getting better, institutionalizing a growth strategy flywheel, especially with what it calls revenue growth management, having the right brand at the right price in the right package for consumers. To put numbers on that, Coke has 200 brands, 32 of which have over $1 billion in annual sales, which are consumed in 2.2 billion drinks per day in some 200 countries around the world. No wonder Coke made Morgan Stanley's Global Best Business Models list. Yes, inflation is a bad guy for Coke's business, but the company's expert in modeling out price changes in inputs like sugar, corn syrup, aluminum, and plastic, and in pricing to consumers. A critical metric that Galbo points to is unit case volume, or UCV, which for Coke is shipments of concentrate, a true underlying demand driver. In the first quarter, Coke's UCV was up 3%, while the street was looking at 0 to 1% growth, he says. And Coke continues to reduce its bottling operations, which has driven operating margins from the low 20% range 10 years ago to the low 30% range today. A quick word about new CEO Barron, a Brazilian American with a master's from Michigan State University who's been at the company for 30 years. Enrique has worked closely with James Quincy in Latin America and throughout the organization on revenue growth management, says Goldman's Herzog. I don't foresee dramatic changes. It's almost like taking that baton and continuing to run the race. I think he'll be even more global. Enrique is well thought of by Coke's most important constituents, the bottlers, says Galbo. That relationship really flourished under James. The continuity factor of having somebody that the bottlers truly know and respect is incredibly important to sustaining the success of Coke. Coke's board has some intriguing dynamics. Recall that Buffett served as a director for 17 years, from 1989 to 2006. A low point was when he and others blocked Coke from buying Quaker Oats and its valuable Gatorade business, which Pepsi snapped up. Today, there are two Buffett disciples on Coke's board: Tom Gaynor, CEO of Mini Berkshire Markel Group, and investor Chris Davis, who's also on Berkshire's board. Herbert Allen III, president of boutique investment bank Allen & Company, has had a board seat since 2021, taking over from his father, who joined the board in 1982 after Coke bought Columbia Pictures. The board recently beefed up its Silicon Valley ties with the addition of PayPal mafioso Max Levchin, former Meta Platforms and Microsoft executive Carolyn Everson, and Bella Bajaria, chief content officer of Netflix. Then there's that Coke versus Pepsi rivalry. In recent years, Coke has won this race, even as Pepsi, which has a broader portfolio, including Frito-Lay in the salty snacks category, has leaned into healthier food and drinks. Bigger than Coke, with $94 billion in sales last year versus Coke's $48 billion, Pepsi is nonetheless worth $211 billion to Coke's $336 billion. Why? For one thing, Coke has $13.1 billion in net income last year, while Pepsi did $8.2 billion. The rivalry extends to our two analysts. Herzog prefers Pepsi over Coke, and Galbo is Coke over Pepsi. The reason comes down to valuation and the risk-reward, Herzog says. I think a lot about Coke is broadly priced in. Pepsi is underperformed and is in the middle of a turnaround. She notes that Coke's forward 12 months price-to-earnings ratio of 23.8 versus 17.9 for Pepsi is well above its historical average premium. As for Galbo, he says the value driver of Pepsi isn't the beverage business, it's the food business, Frito-Lay. The salty snacks category has had a lot more significant headwinds, there's that word again, over the past several years. Galbo points to GLP-1 phobia, but more importantly, he notes that the prices for salty snacks climbed some 30% from 2021 to 2024, which hurt demand. Buffett made his choice some 40 years ago, reportedly swapping out a stake in Pepsi to buy Coke. Still, you wonder about Coke's continuing appeal to Abel. Sure, with Coke's 2.71% yield, Berkshire takes home $848 million a year in dividends on its stake. But there are plenty of stocks out there sporting more generous payouts. I'm guessing that Buffett and Abel would point to safety of the yield, the continuity of Coke's strategy, and the continuously improving execution. And maybe some of that mirrors Berkshire. Ken Burns knows American history. What about American business? I recently spoke with the award-winning maker of such documentaries as The Civil War and Baseball, and his latest, The American Revolution, as part of our At Barron's interview series. I asked Burns about the role of business in the American Revolution. Well, it's all economics in some ways, he says. This is about money, taxation. You're going up against the biggest empire on earth, the British Empire. How do you fund the war and a revolution? You're having financiers like Robert Morris who are putting money in. He financed the revolution, and the revolution financed him. There were people making money. Burns has relationships with some bold-faced names that Barron's readers know well, like Brian Moynihan, CEO of Bank of America, and Steve Schwarzman, CEO of Blackstone, who have underwritten Burns' endeavors. I have a special relationship with Brian, Burns says. He majored in history at Brown University, and his mentor there is Gordon Wood, who's in our film on the Revolution. And Brian and I meet periodically. We take care of the business side of things. This is the budget for next year. These are the films that we're thinking about. And then the rest of the time, we talk about history. I met Steve Schwarzman in 2017, and we regularly talk on Zoom or get lunch. He's been incredibly generous supporting the American Revolution and other things we've done. He's got some incredible perspectives about what's going on in the U.S. and the world. Neither of these benefactors have a say in the editing room, Burns says. Burns himself is a CEO, owning and running Florentine Films for some 50 years. For the last 20 years, our sole corporate underwriter has been Bank of America. 22 years before that, it was General Motors. I've done everything the opposite of what I was told to do. I was told to stay in New York, so I moved to New Hampshire. I've been told you should adopt this technology or have more bells and whistles. I've never gotten investors. My film on the Vietnam War came out in 2017. It took 10.5 years. Cost a little bit over $30 million. I could have walked into a streaming service or premium cable and walked out with that $30 million. What I couldn't have walked out with was the time I needed to get to the heart of the story. Burns says he's avoided a layer of suits saying, longer, no shorter, sexier, less sexy, more violent, less violent. Instead, he made an essential sacrifice that has for me been the right decision. May not be for another filmmaker who might go to an HBO or to a Netflix, but this is what's worked for me. With a look back at what happened last week and a look ahead to what's scheduled to happen this week, we have the review and preview session in Barron's of May 11th. Prada kicks off summer. This is shaping up to be one of the best summer movie seasons of all time, and certainly since the pandemic, says Paul Dugarabedian, ComScore's head of marketplace trends. It could beat summer of 2023 when Barbie and Oppenheimer drove summer box office sales to over $4 billion. This past weekend's $172.5 million in total domestic box office was 18% higher than the same stretch in 2025, bringing year-to-date sales to $2.79 billion. That's up 14% from this point in 2025, says ComScore. The season began this past weekend, as moviegoers flocked to see Meryl Streep and Anne Hathaway reprise their roles as a fashion magazine diva and her former assistant in Walt Disney's The Devil Wears Prada 2. The sequel to the 2006 hit topped the domestic box office with some $77 million through Sunday, says ComScore. Dugarabedian says the film overperformed internationally, raking in another $157 million. The industry is also benefiting from the Michael Jackson movie Michael, which after its second weekend brought in some $200 million domestically and $441 million worldwide. Nintendo's The Super Mario Galaxy movie and Amazon MGM's studio space epic Project Hail Mary are also faring well. Up next, Warner Brothers' Mortal Kombat 2. The 18 weeks from May through Labor Day account, on average, for 40% of domestic box office sales, so it's vitally important to the industry, says Durga Rabidian. That was written by Janet H. Cho. Last week in markets, the week began with Iran warning it would attack U.S. Navy vessels if they tried to escort ships through the Strait of Hormuz. Iran fired at ships in the strait and at the United Arab Emirates. Oil prices rose, stocks were mixed. On Tuesday, President Trump backed off the escort plan, saying that negotiations were on again. Oil fell. Stocks rallied as indexes set new highs on peace hopes, but clashes continued. April U.S. jobs grew by a better-than-expected 115,000. On the week, the Dow Industrials rose 0.2%, while the S&P 500 and NASDAQ composites set new highs, up 2.3% and 4.5% respectively. In companies last week, Trump raised European car tariffs from 15% to 25%, and a U.S. trade court blocked his 10% global tariffs. Berkshire Hathaway's cash pile hit a record $397 billion in the quarter, as CEO Greg Abel took over from Warren Buffett. Berkshire also named General Re chairman Charlie Shamia to replace retiring insurance chief Ajit Jain. Elon Musk agreed to pay $1.5 million to settle a Securities and Exchange Commission lawsuit that he failed to disclose his Twitter stake in 2022. Walt Disney's new CEO, Josh D'Amaro, outlined his plans in a 3,000-word shareholder letter. NVIDIA made a $500 million investment in Corning to boost fiber optic growth. ARM Holdings said demand for its chips was outstripping supply. Samsung Electronics joined the $1 trillion market cap club. It's getting crowded. In deals, GameStop made a $56 billion cash and stock offer for eBay. This week, on Monday, May 11th, nearly 90% of S&P 500 index companies have reported first quarter results so far, with more than 85% beating earnings per share estimates and 80% surpassing sales expectations. This goes a long way to explaining why stocks are at record highs, despite elevated oil prices and an uncertain path to ending the war with Iran. This week, Constellation Energy releases earnings on Monday, followed by Cisco Systems on Wednesday and Applied Materials on Thursday. On Tuesday, May 12th, the Bureau of Labor Statistics releases the Consumer Price Index for April. Consensus estimate is for a 3.7% year-over-year increase, 0.4 of a percentage point more than in March. The core CPI, which excludes volatile food and energy prices, is expected to rise 2.7%, compared with 2.6% previously. If estimates prove correct, the headline CPI would be the highest annual rate of change since September of 2023. On Thursday, May 14th, the Census Bureau reports retail and food services sales for April. Economists forecast a 0.6% month-over-month rise after a 1.7% jump in March. Excluding autos and gas, retail sales are seen increasing 0.4%, 0.2 of a percentage point less than previously. The numbers: $5 billion. That's the rise in commodity costs the big Detroit automakers say they will face if the Iran war lasts 2 more months. 90%. That's the increase in some aluminum prices in the past year from tariffs, higher delivery costs, and the Iran war. 15%. That's the percentage in a Harvard poll of those ages 16 to 29 who say they trust the federal government. That's a record low. And $4 billion, a forecast of the combined free cash of Amazon, Alphabet, Microsoft, and Meta platforms in the third quarter. Budget air travel is under siege. These stocks will benefit, by Jack Huff. This is the cover story in Barron's of May 11th, 2026. Picture an excessively mobile middle-class family that does almost nothing but drive, traveling from New York City to Los Angeles and back again each week. Its gasoline bill, instead of taking up a typical 5% of its budget, might come in over 30%. That's about what it takes to keep an airline fueled under normal circumstances. Now, consider that the price of jet fuel has outpaced gasoline this year, more than doubling. Spirit Airlines recently succumbed. Remaining airlines are scrambling to raise prices. Domestic airfares are already up 36% this year, according to data from Kayak. That means pricier summer trips for vacationers who haven't yet booked, with longer-term implications for the airline industry and its investors. The future of the ultra-low-cost carrier, a breed of cramped flyer that dominates in Europe, is in question in America. At the same time, the strongest airlines, including Delta, United Airlines Holdings, and some of the rest now doing their best impressions of these two, could benefit from present turmoil and generate healthy stock returns for years. From low cost to blue chips. Surging fuel prices alone didn't kill Spirit. Accessories to the act included labor shortages, engine problems, a financially squeezed customer base, and competition from basic economy fares at the big players. Spirit's market share, having fallen for years, will now probably flow to Frontier Group holdings in JetBlue Airways. Both of these are nonetheless expected to burn cash this year and next, as they have since the start of the COVID-19 pandemic in 2020. Both are moving beyond their low-cost roots. Frontier is adding first seats. That's a roomier 2x2 configuration in the first two rows. JetBlue already has a lie-flat layout called Mint on certain cross-country and transatlantic flights, and on other flights it will now add more traditional first-class seating, which the industry has nicknamed Junior Mint. This is where Delta leads. Paid premium seats on domestic flights, one of the industry's three biggest moneymakers. It's quickly expanding in the second one, international flying. And it cleans up in the third, loyalty revenue, including from credit cards, retail partners, and lounge memberships. This high-margin, non-flying income doesn't burn fuel, go on strike, or suffer weather disruptions. United, meanwhile, leads in international flights and is growing from a strong position in domestic premium and loyalty. These two could be described with words that Wall Street isn't used to seeing together. Blue chip airlines. Each is projected to generate close to $2 billion in free cash this year, a fraction of what they're capable of, but pretty good for a bad year. Playing from behind. American Airlines Group is trying to catch up. It's adding new planes with lie-flat seats on select routes and expanding a credit card partnership with Citigroup. But progress could be slow and expensive, not least because of a decade-long backlog for new aircraft and an on-time service rate that typically lags behind those of Delta and United. Southwest Airlines isn't going first class yet, but it has left behind its all-inclusive low-cost model. Since last year, it's added baggage fees and ended a half-century of open seating, charging more for extra legroom and preferred locations. The extra income could turn free cash flow positive for the first time in years, but it will be a close call now that fuel prices have spiked. Alaska Air Group is suddenly a top 5 U.S. player after its 2024 buyout of Hawaiian Airlines, although there's a steep-sized drop after American, Delta, United, and Southwest. The Hawaiian deal brings a key trans-Pacific hub, more long-haul flights with premium seats and airport lounges, and a consolidated loyalty program, which moves Alaska from a cheap West Coast flyer to a more traditional carrier, if not quite a global one. None of this means a permanent end to cheap flights. You don't have to have an ultra-low-cost carrier to have a low fare, says Daniel McKenzie, an airline analyst at Seaport Global Partners. All you need to have is 3 to 5 airlines sitting on top of each other in a market that they all love and they all want to own. But the brashest experiments in cut-rate flying might subside for years, given shortages of pilots, airport slots, and just about everything else they depend on. The European model. There's an Irish airline executive named Michael O'Leary who so loves upcharges and cost-cutting that over the years he's floated selling standing room flights, charging overweight passengers more, and installing coin-operated restrooms. None of these were implemented, but the buzz they generated drew attention to his cause. In just over 30 years of running Ryanair Holdings, O'Leary has transformed it from a small money-losing competitor to Aer Lingus to the largest airline in Europe by passenger count, and one whose profit margins dwarf those of flag carriers like Deutsche Lufthansa and Air France KLM. Ryanair has done this by posting extremely low base fares and then charging for everything it can, including checked bags, all but the smallest carry-ons, seat selection, and food and drinks. Today, this type of airline is known as a ULCC, or Ultra Low Cost Carrier. Ultra and even low are subjective, and airlines sometimes adjust their business models so there can be disagreement over which are true ULCCs. But not in Ryanair's case, and maybe not in Frontier's, given that it has taken ULCC as its ticker symbol. Before transforming Ryanair, O'Leary made a careful study of Southwest and its no-frills, high-efficiency model, featuring a single aircraft type, point-to-point flying instead of hub and spoke, and quick plane turnarounds between flights. He then brought Southwest's model to Ireland in a much more extreme form, even a hard-edge one. Whereas Southwest took the ticker symbol LUV, love, and built a reputation for customer service with personality, Ryanair charged even for customer service calls and ticket printing. So then, why can't this American business model tweaked for Europe work in America? Well, it did. At first. Spirit, once a charter airline turned small scheduled carrier, took a private equity buyout, transformed into a Ryanair-style ULCC, and it went public in 2011, pricing shares at $12 each. They topped $80 just a few years later. But major airlines, after experimenting with fun, cheap leisure brands like Delta's Song and United's TED, and folding them, launched stripped-down basic economy fares. These were designed to compete with ULCCs while filling planes with candidates for loyalty programs. After COVID and the surge in revenge travel that followed, Spirit's labor costs jumped as pilots, after many years of concessions, found themselves with bargaining power amid a pilot shortage. Airport renovation projects drove landing fees higher. Leisure travel became more price-sensitive, as middle-class consumers got hit harder by inflation than wealthy ones. And with corporate travel slow to recover, major airlines competed harder for leisure. A Pratt & Whitney engine problem grounded 20% of Spirit's planes at one point. A failed merger with Frontier and a disallowed buyout from JetBlue distracted from operations. After 2 bankruptcies and a failed attempt to secure another government bailout, Spirit shut down. In hindsight, Spirit couldn't get costs low enough. Airlines measure capacity using something called an available seat mile, which is 1 mile flown by 1 seat, with or without buttocks. Ryanair's cost per available seat mile has historically been about 6 cents, including fuel, and among the lowest globally. Spirit got down to about 11 cents and struggled to stay there after COVID. Some of the differences seem unavoidable. Ryanair flies shorter flights among different countries, allowing it to pack seats tighter and source labor where it's relatively cheap. And it uses more small airports, which offer low fees and marketing support to lure traffic and can turn planes around quickly. We expect Delta, United, and American to continue outperforming the ULCCs, given many of the advantages are structural, wrote TD Securities in an investor note this past week. Capacity cuts by the ULCCs should result in a more rational domestic pricing environment, which in turn should help buoy full-service margins. A turbulent history. Cash incinerators. Fixed-cost disasters with wings. If you want to make a small fortune in airlines, they say, start with a large one. The industry has long been a Wall Street punchline, and deservedly so. Just count the bankruptcy filings. United in 2002, Delta 2005, American 2011, and U.S. Airways twice before merging into American. No wonder Warren Buffett wrote in a 2007 letter to shareholders that a far-sighted capitalist at Kitty Hawk would have done successors a favor by shooting Orville down. This year, the group is understandably trailing the S&P 500 index. But over the past 3 years, Delta and United have nonetheless returned 123% apiece versus 85% for the index. Is that a fluke or a sign of where things are headed after fuel costs subside? Perhaps the latter, and with one or two others shining too. Delta, trading at 13.6 times this year's humbled earnings forecast, has a credible path to doubling earnings per share over the next 3 years. The same goes for United at 10.9 times earnings and Southwest at 16.6 times earnings. American gains the most from Spirit's exit on an absolute basis, and Frontier and JetBlue are large relative beneficiaries, but these are risky bets. American's heavily indebted and not expected to turn a profit this year. For those who believe that its turnaround effort will be at least reasonably successful, it trades at just 3.3 times the consensus earnings estimate for 3 years from now, or less than half of the price of Delta. JetBlue has only one fan on Wall Street among 19 analysts who cover the stock, McKenzie at Seaport Global. I just concede it. Things have to work in my favor for this buy to work, he says. JetBlue has added billions of dollars in debt since the outbreak of the pandemic. But while the consensus has the company burning more cash next year, McKenzie is predicting $500 million in positive free cash flow. A start, in other words. This is partly because he expects fuel costs to come down, and partly because JetBlue's strength in New York to Florida flying overlaps nicely with Spirit's former main hub in Fort Lauderdale. JetBlue's valuable slots at New York's LaGuardia and JFK airports also give it takeover appeal beyond its earnings potential, and a deal window might be open due to the argument that government antitrust intervention helped push Spirit under, rather than preserve it as a low-cost competitor. But JetBlue's debt load would be tough for any of the big carriers to swallow. A loose partnership between JetBlue and United might point toward a more likely path. The two airlines can book flights using each other's frequent flyer points. JetBlue can swap some of its LaGuardia and JFK slots, while United in particular prizes many of its overseas passengers would rather fly into New York City than Newark, New Jersey. McKenzie recommends a scattershot approach to airline stocks. We have to have not a social media post, a credible line of sight to the war in Iran ending, he says. And so I hate these stocks near term, love these stocks over the coming year. But there's one airline stock he doesn't recommend buying. Indeed, no one does among a dozen analysts who cover it, and that is Frontier. Brent crude oil started the year at $62 a barrel. It went for $124 at the end of April, and it was recently hovering just over $100. If it went to $125 and stayed there, McKenzie reckons Frontier would have to file for bankruptcy protection and exit a lot smaller. His base case is that it survives the current crisis, albeit wounded, returns to profit, and grows by about 10% a year. A trade group that launched last year called the Association of Value Airlines recently petitioned the government for a $2.5 billion pool that budget carriers can tap to keep airfares affordable. Beyond Spirit, its full members are Frontier and three others. Sun Country Airlines Holdings, taken public by private equity firm Apollo Group in 2021, specializes in leisure flights from Midwestern cities to warmer locales and cargo flying for Amazon.com. Allegiant Travel, which has agreed to buy Sun Country, does limited frequency vacation flights from small markets. Think Appleton, Wisconsin, and Allentown, Pennsylvania. Finally, Avalo is similar to Allegiant but smaller, privately held, and with some different airports, such as Tweed, New Haven in Connecticut, and Lakeland Linder International between Tampa and Orlando. There's still going to be a ULCC presence, says McKenzie. It's just not going to be as big and fast-growing a segment as it once was. Our next article in the Barrons of May 11th, the push to free Fannie Mae and Freddie Mac. Investors in the mortgage giant stand to realize billions of dollars if the government releases the companies from conservatorship, by Joe Light. Michael Burry bet against the subprime mortgage market 2 decades ago. The former hedge fund manager, made famous by the book The Big Short, recently said he was buying shares of mortgage giants Fannie Mae and Freddie Mac. Hedge funds and retail investors for years have been lured, and often burned, by one of the biggest all-or-nothing bets in stocks. Now, prominent investors are betting that President Donald Trump will give them what no other president has since the government took over the companies in 2008, a payoff on their shares. Although publicly traded, Fannie and Freddie have been under U.S. conservatorship since the 2008-2009 financial crisis, and they haven't sent profits to shareholders. Until recently, shareholders hoped Trump would release them from government control and turn the profit spigot back on. Now some shareholders are pushing the government to move down a less ambitious path that would leave Trump in control, while still helping shareholders collectively realize billions of dollars on their stock. "We're thinking about taking it public, taking a little chunk out of it," Trump said on May 1st at an unrelated event. "I don't know what the hell we're going to do." The second Trump administration has given Fannie and Freddie holders a wild ride. Shares of the companies skyrocketed last summer after the president said he was considering taking them public. But since September, both stocks have dropped about 50%. Persistent inflation and the Iran war have fueled doubts that Trump will push for releasing the companies. Some administration officials have argued that the proceeds from the government's stock sales could cut the deficit, or that Congress could use the money for other priorities, such as supporting affordable housing. Fannie and Freddie buy mortgages from lenders. They wrap them into mortgage-backed securities and guarantee to make bond investors whole if borrowers default. That system makes 30-year fixed-rate mortgages cheap and plentiful, although it rests on the belief that the government would bail out the companies if they ran into trouble. After the government took over Fannie and Freddie in 2008, it injected them with more than $190 billion in bailout money. In return, the Treasury received warrants to acquire nearly 80% of the company's common stock and a new class of senior preferred shares. The government's claim has since grown to more than $370 billion. The government left outstanding the company's common stock and legacy junior preferred shares. In the years after the crisis, institutional investors, including Fairhome Funds, Paulson and Company, and Pershing Square Capital Management, bought common or junior preferred shares on the bet that the companies would one day send profits to private investors again. Burry disclosed a major stake in Fannie and Freddie in December and said last month in a Substack post that he had bought more. Behind the scenes, shareholders are pushing Trump to make a move. Hedge fund Point State Capital earlier this year hired a firm to lobby the administration, according to federal filings. Pershing Square founder Bill Ackman also held several meetings with administration officials earlier this year to pitch his most recent plan to restructure the companies. The crux of Ackman's plan is for the Trump administration to retire the government's $374 billion senior preferred claim on Fannie and Freddie. Fannie and Freddie are stupidly cheap, Ackman said in an X post in March. Asymmetry at its best. They could be a 10x, and it could happen soon. Analysts for years avoided evaluating the shares because of their political risks, but have recently begun to initiate coverage. On Monday, Mizuho Securities gave Fannie and Freddie outperform ratings with $10 and $9 price targets, respectively. The current administration has the political motivation to complete what it began in its first term, wrote Mizuho Managing Director Dan Dolev. Fannie's and Freddie's shares look extremely cheap by any standard valuation metric, but calculating one is mostly a waste of time. That's because there's no way for shareholders to know what Trump will do with the government's common and senior preferred shares, or when he'll take action. In the most negative scenario for common stockholders, such as Ackman, Trump could not only exercise the warrants to acquire almost 80% of the companies, but also seek to convert the senior preferred shares to common, which would leave the government with near total ownership. Many hedge funds have considered Fannie's and Freddie's junior preferred shares a safer bet. Those shares recently traded at less than half of their par value. The funds bet that a restructuring could pay near par or leave them with an equivalent amount of common. That, too, is a gamble. During the first Trump administration, Treasury and Federal Housing Finance Agency officials considered restructuring plans that would dilute the junior preferred and common holders, probably leading to more court battles. There's no fundamentals to this trade. It's completely politically based, said Stephen Myrow, managing partner of Beacon Policy Advisors. Lately, Trump and other government officials have floated the idea of selling a tiny slice of Fannie and Freddie, rather than trying to sell all of the government's stock at once. In his remarks on May 1st, Trump alluded to a plan from FHFA Director Bill Pulte to sell about 5% of the government's shares in the companies, which would raise a relatively small amount. It's peanuts, Trump said. You take it public, it buys 15 missiles. The White House and Treasury Department didn't return Barron's request for comment. It's unclear how mortgage bond investors would react to such a step. Bond investors have warned that changing the government's relationship with Fannie and Freddie could raise mortgage rates if the market no longer trusts that the government would bail them out in a crisis. Analysts say there are other steps that the Trump administration would probably have to take if it decides to move forward with selling shares. This is not something that Trump can just post on Truth Social and then it will exist, said Ben Elliott, an analyst at Bloomberg Intelligence. It's an incredible amount of on-ramp to lay the groundwork. Fannie and Freddie shares will surge anytime Trump hints that a share offering is coming. But until he takes concrete steps, they're a speculative bet. The next Barron's article: this private credit leader is riskier than it looks. The big Ares Capital Fund has attracted business by allowing many borrowers to defer paying cash interest. It could end badly, by Bill Alpert. As individual investors bail from many private credit funds, Ares Capital remains an investor favorite. The fund trades at just 1% below its book value, while publicly traded credit funds average 20% discounts to book. It pays a generous dividend, and most of Wall Street rates it a buy. Yet its penchant for letting borrowers pay interest on their loans with non-cash IOUs could set the fund up for trouble if the lending environment deteriorates. The $30 billion Ares fund, often referred to by its ticker symbol ARCC, is the largest publicly traded business development company, a form of private credit fund exempt from corporate tax. The fund has averaged 12% annualized returns since its 2004 initial public offering, and it's maintained or raised its dividend for 17 years running. That record helped launch the sprawling complex of funds now run by its advisor, Ares Management. Ares Capital differs from other high-rated BDCs in riskier ways. More of its holdings are equity investments, while fewer are the first lien senior secured loans that are prized by credit fund investors. Notably, more of the investment income booked by Ares is in the form of IOUs, not cash in hand. To win loan deals in recent years, Ares allowed many borrowers to defer paying cash interest with payments in kind, or PIK, that get tacked on to the outstanding loan. In 2025, non-cash PIK interest and dividends were nearly $490 million, or 34% of Ares' net investment income. A decade ago, PIK was 8% of its net investment income. In most of the past 10 years, Ares' dividend payouts haven't been covered by the cash components of its net interest and dividend income, according to the company's financial statements. Money from loan repayments, investment gains, and capital inflows helped the BDC satisfy its dividend obligations. It is something to be concerned about, says Robert Willens, a veteran accounting analyst focused on Wall Street. While collections are robust, it's not something to be worried about. But when collections are not, Ares Capital has had few bad loans, and its approach has worked for 2 decades. The BDC told Barron's that its past 5 years of dividends were fully covered by cash collected as interest and dividends, along with investment gains. We continue to believe that ARCC's current dividend approximates the long-run underlying earnings power of our business, CEO Kort Schnabel told listeners on last week's earnings call. The bread and butter of a direct lender like Ares Capital is lending to companies acquired by private equity firms. These mid-sized businesses often take on heavy debt loads at rates that float 5 percentage points or more above the benchmark rates paid by investment-grade borrowers. When the Federal Reserve began hiking interest rates 4 years ago, it buoyed private credit's floating rates as high as 11 and 12%. To make those rates bearable, credit funds structured some loans at the outset to let borrowers meet some interest obligations with non-cash payments in kind. Like banks, the credit funds can include these non-cash PIK receipts in their GAAP earnings, GAAP. Since investors prefer to get their dividends in cash, a fund that's getting more of its interest as PIK must find the cash for dividends elsewhere, or cut the dividend. PIK loans have become entrenched in direct lending. From 2022 to 2025, loans with some portion of PIK increased from about 10 to 18% of portfolio assets at publicly traded BDCs. That's according to Raymond James. Benchmark rates have cycled down, but non-cash lending hasn't. Ares Capital has been making PIK loans for many years, so it was comfortable offering non-cash terms to win business from rivals like Blue Owl Capital and Blackstone. ARCC also took preferred stock from corporate borrowers and accepted PIK dividends. The fund says it takes equity only in the best borrowers. These minority equity investments are made selectively, generally alongside loans that we originate and underwrite ourselves, allowing us to participate in the equity where we see particularly strong upside cases, said ARCC President Jim Miller on last week's conference call. That has produced a portfolio at ARCC that looks different from its big BDC peers. To calm the nerves of individual investors, other fund managers lately have highlighted how much of their holdings are first lien senior secured loans, which sit on top of a company's capital stack, and they get paid first if a borrower comes to grief. Such loans made up 80% of the average BDC portfolio last year, says Raymond James. At the $14 billion Blackstone Secured Lending Fund, another highly valued BDC, 98% of investments are first lien loans. First lien loans were 60% of Ares' portfolio at the end of March. Another 11% were second lien and junior loans. The remaining 29% were various kinds of equity. Ares says that its equity selections have done well. In fact, the sale of 4 equity positions helped cover the March quarter dividend. Over the last 10 years, our equity co-investment portfolio generated an average gross internal rate of return well in excess of the double-digit total return of the S&P 500 index, Miller said on the earnings call. Portfolio yields on its first lien loans were about 9% last year. Equity and junior debt yielded about 11%. Unlike other BDCs, Ares hasn't paid a high price for its reliance on PIK interest. Two other listed BDCs with high levels of PIK are FSKKR Capital and Blue Owl Technology Finance. They trade at 2/3 of Ares' book multiple. Ares says it has a good record with PIK. In more than 190 PIK deals since the fund's 2004 start, Ares has made back 1.4 times its capital in those deals, Miller said on last week's call. We've selectively used PIK over our history, Miller said. As with all investments, PIK investments are underwritten with the same discipline as cash pay loans, with a strong focus on structure, leverage, and exit protections. Cash flow coverage of its dividends is another matter. Without including non-cash PIK, Ares netted $930 million in cash interest and dividends last year, after expenses. The fund paid $1.26 billion in dividends. Dividend payouts have exceeded cash net investments income for most of the past decade. Ares says that isn't the right way to look at its dividend coverage. Most BDCs have just one line on their cash flow statement showing loan repayments. Ares has a line showing the cash received for the principal payoff, and then a separate line showing cash collected for the deferred PIK interest when loans are paid off. In 2025, for example, Ares collected about $130 million in past period PIK interest from loans, and another $150 million from previously deferred PIK dividends from preferred stock. These PIK collections should count toward a period's dividend coverage, says the fund. So should performance fee adjustments and investment gains. Counting that way for the period since January 2021, Ares tells Barron's, "We believe our base dividends have also been fully covered by cash flow over that period." Adding last year's $280 million of PIK collections and $100 million in investment gains to $930 million of cash net investment income, the $1.26 billion in 2025 dividends were covered. PIK collected as part of a loan payoff seems a less reliable source of dividend cash than regularly paid cash interest, says Nick Nemeth, a consultant and independent analyst who has studied private credit. Cash interest and dividends will come in as long as borrowers have the cash flow, but PIK collection depends on investments getting repaid, refinanced, or sold, he notes. If they collect the cash at the end of the day, then they collect the cash at the end of the day, Nemeth says. The PIK cash flow is lower quality to be sure. Ares has delivered for its shareholders, but its reliance on PIK interest, junior debt, preferred stock, and investing gains could be problematic in a down market. And we will close with the economy section of Barron's with an issue date of May 11th. How Warsh Could Prove His Fed Critics Wrong by Nicole Goodkind. Kevin Warsh, who's expected to be sworn in as the next Federal Reserve Chair this month, will inherit a central bank that appears stuck in policy limbo due to concerns about escalating inflation. But he may have more options to lower interest rates and achieve his other goals than investors think. Bond traders no longer expect the Fed to cut rates this year. 3 regional bank presidents broke ranks at the April 28th and 29th policy meeting to vote against language suggesting the next rate move would be a cut, and inflation is still well above the Fed's 2% target. The dominant view on Wall Street is that Warsh will be boxed in. While the Trump administration is pressing for cuts, the Fed's policy committee is heading in the opposite direction. But that assessment underestimates both the man and the moment. Warsh has a workable path, and it runs through the middle. If he persuades the Fed to hold the federal funds rate steady through the summer, in a current range of 3.5 to 3.75%, removes the signal that a cut could be coming, and waits for more clarification on the impact of energy prices before recommending a rate change, he will satisfy the hawks on his committee. He'll deny the White House an easy target and preserve the credibility he will need to make larger moves later this year. Meanwhile, the view from the White House is moderating. Treasury Secretary Scott Bessent, who pushed aggressively for rate cuts earlier this year, softened that position in recent weeks, giving Warsh political cover that current Fed Chair Jerome Powell has never enjoyed. Investors have already adjusted to a Fed on pause. Holding rates steady would merely confirm what's already priced in. Warsh has long advocated for a number of changes at the Fed. Among them, he wants to trim the Fed's $6.7 trillion balance sheet and reduce officials' focus on reported economic data, arguing that the policy committee reacts too mechanically to each new economic report. One likely change is the way officials read inflation. The Fed's preferred inflation gauge is the Core Personal Consumption Expenditure Price Index, excluding food and energy. Warsh's preference is trimmed mean inflation, which discards categories with the most extreme readings on both ends. By that measure, inflation appears much closer to the Fed's target than the headline numbers suggest, building the case for eventual cuts. Warsh has also said that artificial intelligence will hold inflation down over time. The bigger reform on Warsh's mind is the size of the Fed itself, and it's a big reason for not spending his credibility on a quick rate cut. He's argued for years that the balance sheet, now around $6.7 trillion, has grown far beyond what the economy needs. Shrinking the balance sheet and cutting rates may sound contradictory, but selling off bonds could push long-term rates higher. Cutting the short-term policy rate would push in the opposite direction. The combination could let Warsh shrink the Fed's footprint without choking off the economy. But it's a delicate situation and sequence that requires the confidence of the committee, which is exactly what an early contested cut would put at risk. Inflation will test Warsh almost immediately. The hawks could push further, actively pressing for a hike if energy prices keep climbing. Powell's decision to stay on as a Fed governor may also limit Warsh. While Powell has promised to keep a low profile, his continued presence may narrow the reform agenda. But Warsh's path exists, and is more navigable than the current consensus allows. The patient course, in this case, is also the ambitious one. And with that, we've come to the end of our reading of Barron's for May 11th of 2026. This is your reader, Eric, saying be well, be safe, look after each other, and remember our veterans, especially those we've lost recently. Bye for now.